Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent FOMC. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. So we did have another FOMC today. As always, these meetings, each one is the most important one of our lives until the next one, of course. And so today, the Fed raised interest rates by another 25 basis points to get us to a Fed funds rate of 5.25%. Now, note that this was the terminal rate during the hiking cycle back in 2004 to 2006. Of course, this time we got there very quickly, and we also started from a much lower level. You can see we started from 0.25. Over here, we started already at around 1. So not only did we go to that same level, but we started at a much lower level, and we got there in a much quicker fashion than we ever did back then. So interest rates are at 5.25. If you remember, over a year ago, I said that I think the terminal rate will be somewhere between 5 to 5.5%, right? So we're in that range. We're well within that range. We're right at 5.25. It's possible they could go another 25 basis points. We're going to have to see, how things shape up here with inflation data coming in. Now, I will say there have been some changes to what was ultimately said. If you read the report, you'll note that it'll say in determining the extent of which additional policy framing may be appropriate, etc. They're basically looking to be data dependent, right? Whereas in the past, they sort of would say things like they anticipate that ongoing rate hikes would be appropriate or something along that line, right? There is at least wording in here to imply that a pause could happen if the data allows for it. However, when pressed about it, Powell was unwilling to say, definitively or not. He said they didn't really talk about it a whole lot and that they'll talk about more about that at the June meeting. He was also unwilling to say if 5.25 was sufficiently restrictive or not. He said that, in terms of talking about the banking sector, he said something that I think is a little bit controversial because one of the first things he said when he came out was that conditions in the banking sector had basically vastly improved since March. And that's not necessarily true. I mean, yes, some of the issues were sort of dealt with, but even after hours today, we saw some more regional banks really starting to plummet. And one of them is this one right here. And you can find this ticker on TradingView or whatever if you want to look, that PACW. And you can see that after hours, it's down another 52%. I mean, this isn't normal, right? I mean, it's not normal for regional banks to just drop this amount. And obviously, it came out on news that they're obviously having some issues and potentially looking for a buyer, I believe. But this wasn't the only one that was down a lot today. I mean, there's also a couple other banks that I saw that were down quite significantly after hours. So it does seem like it's not the most sincere statement today to say that the conditions in the banking sector have improved. I mean, I guess it depends on what your reference point is, but watching more regional banks just drop 30, 40, 50% after hours doesn't really give, a large boost in confidence, okay, when you see that sort of stuff. So just something to think about. The banking sector has been hit quite hard. And I mean, with these high interest rates, it's obvious why, right? I mean, there's obviously a lot of issues going on. A lot of banks, I think, made some policy decisions back when interest rates were low, and they did not really adequately determine if those same type of decisions should be carried out if interest rates were to go back up. And now that interest rates have gone back up, a lot of banks just don't really have enough liquidity to handle this situation. So I don't know that that's necessarily a true statement. I understand where Powell's coming from. He doesn't want to just come out and say, yes, the whole world's melting down around us, it's time to panic, right? He's obviously going to try to paint things over in a different light, but that is at least something that he said. He, of course, reiterated that they're strongly committed to bringing inflation back down to the 2% goal. He talked about how the labor market remains very tight, and it does remain very tight. Yesterday, we did a video on job openings. JOLTS report, I think you should watch. Yes, job openings are coming down, but they're still very high and well above trend. So, yes, they're coming down. They're trending in the direction that they want. The issue is are they going to overshoot it? And one thing that he said, which I'm sure everyone's going to get a kick out of, is that he said that let me see if I can find it. He said it's possible that this time is really different. And the reason is that there is so much excess demand in the labor market. So it's an interesting thing to say, right? Because what he's referring to is the fact that they've already raised 500 basis points. And despite that, the unemployment rate remains at historically low levels. I mean, despite everything that has gone on, it remains at a more or less a secular low. We also know that it's one of the last things to move. And it could take a while for it to move in a material way. I mean, we're actually going to get another report here on Friday, I believe, so we'll see where it is. But in order to get to where they want it to go, it's going to take months and months and months to occur. Now, I mean, I think he is somewhat overly optimistic that it doesn't have to go up just because there's so much excess demand. But we also know, as I've said before, right, that it is a lagging indicator, and that by the time it starts to move, any change in monetary policy isn't going to have an immediate effect. Just like raising rates took a long time for things like continued claims and initial claims to go up. Like if you go take a look at, say, continued claims and see where they are, right, they're going up pretty quickly. But it took a while for this to really take hold. I mean, they started raising interest rates in March of 2022. Continued claims didn't start going up until about half a year later. So again, if they wait for the unemployment rate to start moving to do something, it's probably not going to stop moving just because they decide to do that. We talked about this a long time ago, is that, and this is why we said they're likely going to go, to 5%, is because a lot of people are thinking that, well, when the economy starts to show signs of weakness, they're not going to go above, 3 or 4% or something, because they historically pivot when something like that occurs, when the stock market is showing weakness, whatever it might be. But we have to consider that we are in a period of high inflation, and therefore the Fed is going to do things that they don't normally do, at least not things that we've seen over the last 40 years. And you can look at initial claims and also see that it's going up, right? I mean, it's kind of pausing here for a little bit at this range, but it has been moving up. And if you were to go look at, say, the unemployment level by reason for unemployment and look at job losers, here you can see that's going up as well. So there certainly is some evidence that the labor market is starting to loosen up, although it could still take, half a year for it to really have a material effect on the unemployment rate. I'm not saying the unemployment rate can't go up between now and 6 months from now, but you're probably not going to see the unemployment rate at 8% or something anytime soon, just because there are still quite a few job openings. Again, are they coming down? Yes, they're coming down. But at the end of the day, you still have 9.5 million job openings in total non-farm. So it's still quite a bit, still quite a lot of excess demand that is still there. He also said that, in reference to being asked about could they cut this year, he said that we on the committee have a view that inflation is going to come down not so quickly, and that it would take time, and that it would take some time. And in that world, if the forecast is broadly right, we would not cut rates, and we won't cut rates. Now, the reason why this question was asked is because the market says they are going to cut rates, And if you go look at what the market is suggesting, here, let me reload the page because it seems like it changes every 5 minutes. But if you look at what the market says for June, they're saying 87% chance they're done. And you might think, well, does that mean the rest of the percent is in a hike? No. Earlier today, this was part of a hike, right? It was about a 10% chance of another 25 basis point rate hike, and then 80, 90% chance, 90% chance of a pause. Now the market says, about a 90% chance of a pause and a 10% chance of a cut. So what happened between right now and 6 hours ago, right? As we talked about earlier, right? The regional banks continue to melt down. So I think some people are sort of speculating that the Fed's not going to be able to go too much further. I mean, look, it's possible they go to 5.5. I said that over a year ago, that I think the terminal rate is somewhere between 5 to 5.5%. So it is possible if they go to 5. It is possible they go to 5.5%. If you look at the Cleveland Fed, they're predicting month-over-month inflation for the next report could be coming in somewhat hot. And so if that's the case, and if the job market remains tight, then yeah, we could get another 25 basis point rate hike in June. But if regional banks continue to melt down, then you're going to see a lot of pushback on the idea of them going higher. And right now, there's still a chance. There's a small chance they might actually cut rates. So he was asked basically, well, what are you going to do? And he said, and in that world where we talked about, so we on the committee have a view that inflation is going to come down not so quickly, and that it would take some time. And in that world, if that forecast is broadly right, we would not cut rates, and we won't cut rates. It's not what the market says. I mean, the market could easily be wrong. It wouldn't be the first time, right? I mean, the bond market has been wrong plenty. But look at this. The market says they're cutting in July. What would possibly make them cut in July? I mean, headline inflation is still running very hot. Let me show you guys something. We have a new chart here. If I can, inflation year over year per category. I'm probably going to do a whole video on this, but I just want to show you a couple things. We have it broken. We've broken it down here by category. Look at housing inflation over say the last 5 years. If you're the Fed and you're looking at this, does this look optimistic to you? Does that look optimistic? To look at housing inflation and see where that is, right? They have a big decision coming up, right? Are they willing to stay the course until the job is done, like they've said? Are they willing to do that? Or was it all talk, right? We'll find out. Housing inflation is still pretty elevated, recreation. Does it look like they've made any progress on inflation in the recreation sector? You wouldn't know it. I mean, if you just looked at this chart, you wouldn't know that the Fed just raised interest rates by 500 basis points over the last year, would you? You'd say, inflation looks pretty hot. Now, there are some sectors that look better. For instance, the transportation sector has actually gone somewhat deflationary recently. So these are just things that, Powell's going to have to weigh as we continue to go through this year, because we still have headline inflation at, 5%. But regional banks are melting down now. The S&P is holding up so far. I mean, even Bitcoin is actually right now it's at 29K. So risk assets are holding up. I believe gold put in a new all-time high today on some of these recent moves. Let me see if I can find it. Yeah, I mean, look at this spike. I believe that's a new high for gold at 2081. So Powell certainly is going to have his work cut out for him this year to see how far are they willing to go. And that doesn't mean just raising rates. It means even if they were to pause next month in June, even if they were to pause, how long are they going to be willing to hold them there? Now, this is going to be a tough question, because the thing is if they do what they did in the 70s, then this is what they run the risk of. Inflation coming down, and then just coming right back, and then it coming down, and then coming right back. Powell, I've listened to like everything Powell has said, basically on the public record, for a year now. And he wants to avoid this very, very much. He wants to avoid the mistakes of the 70s. We'll see. We'll see what he's willing to do. I mean, I think it's probably a little bit optimistic by the market to think that they're going to get a cut in July, right? It just seems like there's not a really good chance of that happening. And if a cut does come in July, you have to think, what could possibly cause that, right? Think about how bad things would have to be for them to cut in July, because the unemployment rate is still at secular lows. We're still putting in new highs with real GDP. Okay, I mean, if you go look at real GDP, you can't say that real GDP looks bad. I mean, yes, we came in it wasn't the highest growth, of course, last quarter, but it's still putting in new highs, right? That's not really recessionary territory. We actually just got a new reading on the smooth recession probability indicator that we made a video about a while back, which again is it's based on a Markov switching model that is applied to 4 different variables: non-farm, payroll, the index of industrial production, real personal income, excluding transfer payments, and real manufacturing and trade sales. And as of March, right, because it's looking back a couple of months, as of March, the chance that we're in a recession was only 0.66%, right? Not 66%, but 0.66%, less than 1%. So the economy is still chugging along, right? It's still moving along. It hasn't slowed down nearly as much, I think, as they probably would have wanted it to try to bring it, to hopefully see inflation come back down. But they're going to have to weigh these risks, right? The risk of over tightening and the risk of inflation becoming entrenched, or even inflation expectations becoming entrenched. Because if inflation, if expectations become entrenched, or if they pivot too soon, we could just see this all happen again. And what the issue is that, even if you see some new highs in some assets, the issue is like the 70s. What would happen? You could just come right back down and put in a new low, okay? And you could get in this decade-long period of just a stagnant market where the bulls take it for a few months or a year, and then the bears take over, and then the bulls and then the bears. And we just sort of like playing tennis, right? We just keep hitting the ball back and forth. And at the end of the day, everyone just gets exhausted because you go 5 or 10 years and the market hasn't gone anywhere. Powell wants to avoid that scenario. So again, some interesting times coming up. And then also, if we were to take a look at the yield curve, because that's obviously is of course impacted by rate hikes and whatnot, or in the expectation of what things will happen in the future, we're almost, I mean, the short end of the curve is almost fully inverted, right? I mean, yes, there's some, you can see it kind of comes back up over here, but look, the 2 month is higher than the 3 month, the 3 month is higher than the 6 month, the 6 months higher than the 1 year, and so on and so forth. The only thing that's not here is the 1 month. That could, I mean, there's different theories as to why the 1 month is so low right now. I think one of the theories is of course, the debt ceiling crisis. And if they don't raise the debt ceiling, within the next month or so, then there's a risk, of course, of the U.S. defaulting on their obligations. And so that could have 1 month treasuries were being bid up because the idea was, we'll get our interest before we get to that scenario, right? That was of course one potential theory, but it's almost a fully inverted yield curve. And so one thing to look at is the treasury yield spread on the 3 month and the 10 year. Look where it is. I mean, I think there are periods where it was this bad, but you'd have to go further back than the early 1980s. From we have data here going back to 1982. You have to go further back than that to find a time when it was this inverted. I mean, this is getting into some very deep inversion here. And if you are curious, I mean, I know a lot of people, of course, are into crypto because we talk a ton about crypto here. One thing that is interesting is to overlay the price of Bitcoin over this, because we don't have a whole lot of data. But I mean, if you're curious, like in 2019, once we reached the deepest inversion, the high for Bitcoin was in for the year. Okay, so once that was reached, the high was in. So here you can see the high for Bitcoin in 2019 was reached in June. We reached the deepest level of inversion in September. So just something to keep in mind. By the way, when the uninversion happened, right, that was when Bitcoin went back down. Okay, so we've talked about this before, right? Like half the year is probably Bitcoin going up, half the year is probably Bitcoin going down. And, upon a theoretical uninversion is where you would see probably weakness in risk assets like Bitcoin. Hasn't happened yet, right? And the market can rally until it has enough compelling reason not to do so. And one of those, of course, could be the unemployment rate. Whenever it decides to move, that could be it. Could be any number of things. But I will say this, the stock market doesn't seem that concerned at this moment, right? The stock market, the S&P is around just below 4,100 right now. It hasn't seemed so concerned so far, but look, the bond market, I mean, look, it's saying, cuts could come as soon as July. I don't believe it, but I will say this. If we do get a cut in July, something awful must have happened, right? I mean, something absolutely catastrophic must have happened to cause the Fed to cut as early as July. How do they spin that narrative? Hey, we told you we weren't going to cut this year, but we're just kidding. Even though inflation's still at 5%, we're going to start cutting interest rates in the summer of 23. That doesn't make a whole lot of sense. The only way it would make sense is if something catastrophic happened and they literally just had no other choice. Um, so this is something to follow. I mean, 54% chance here of a cut in as early as July. That's, you're talking about the end of July. So you're talking about what, 2.5 months from now? And if it's not then, still a good chance in September and in November and in December. So we are certainly living in some interesting times right now because Powell's saying one thing about banks and how things have gotten better. Tell that to this bank. Things don't look that great. Powell says that, the labor market's tight. He's right. He says that inflation is high. He's right. He says that, support for the 25 basis point increase was strong across the board, which I think is different than last time. I feel like there were some people that expressed some level of dissent in the last one. So for him to say that support was very strong across the board shows that people are taking inflation seriously. And it also shows that they're looking at these banks and saying, yeah, like this is just what's going to happen. I mean, some are going to get bought out, and one just did. We just saw one get bought out not too long ago. So certainly some interesting times. I mean, again, if you're looking at the yield curve and stuff, remember the time frame for this stuff to get resolved can be a long time. Okay, I mean, I know we talked about the inversion of the yield curve for a while, but it can take a while for these things to sort of resolve themselves. This inversion here happened in October, so we're more than 6 months out. The spread on the 2-year and the 10-year got inverted back in, July of 22, but the first inversion of it was actually in April. So we're more than a year out from that, and almost a year out from more sustained inversion. Just a couple more months, and it will be a full year. Is that anything new? No. We've seen it before. We know that we can stay in this area for a long time. So it doesn't necessarily mean that something catastrophic is about to happen immediately, right? I mean, of course, that. I mean, if you look at this, I mean, it's just continued to go down. We've seen risk assets go up as it's becoming more and more inverted. Wherein lies the problem or the issue is at some point we have to get the resolution of this back up to the upside. And history shows us that's not good for risk assets. We don't know, of course, when that's going to occur. Obviously, these investors think that we don't have long. Stock market doesn't seem to have a care in the world right now, right? So someone's wrong, and we should find out pretty soon who it's going to be. But again, I mean, this was just a sort of a somewhat quick recap of ultimately the meeting and sort of the takeaways from it. And it sort of seems like Powell left the door open for another 25 basis point rate hike, but did acknowledge that the terminology changed. And I don't think he would have acknowledged that if there wasn't a serious chance of them pausing at the next meeting. So yeah, I mean, there's a chance they pause at the next meeting. We'll see. We'll see where things ultimately shape up. But if CPI comes in hot again, like the Cleveland Fed is predicting, and if the labor market remains tight, they could go another one. Anyways, we'll wrap it up there. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up. I'll see you guys next time. Bye.